right? Global economies, especially major economies like USA, are becoming more and more protectionist. So these questions are favorite for UPSC prelims. Virtuous cycle of economic growth. These graphs come handy for your mains examination. The world, what is the global population? Nearly 7.5 billion population. Nearly 40% of the population, they're struggling to meet their basic needs, rather they're paying interest. Hello my dear students, welcome to the YouTube channel Joyful God. I am Jyothi Ganesh. As you all know, under the initiative Easynomics, I have started series of videos related to current affairs for the period January to June 2025. Under that, I have covered topic GDP under macroeconomic performance and policy. Right? So GDP topic was very crucial. There is a tendency among the YouTube viewers to watch short span videos, 2 minutes, 5 minutes, etc. Dear students, in the short span videos, we can cover only concepts. But UPSC does not only demand concepts, but also analysis. Right? My previous video, though the length of the video is a bit longer, it is 45 to 50 minutes, I have made all the efforts not only to cover the facts and concepts, but also analysis. Economics is found to be a much difficult subject compared to other subjects is because students do not take the approach of analytical studies, but they go behind only conceptual understanding. Right? If you want to study economics seriously, being a serious UPSC aspirant, you should not only focus only on concepts and facts, but also analysis. Even the structure of UPSC prelims examination is changing. Right? With respect to economics topic, they are not only asking the facts and concepts, but also analysis. Also, economics can be made easier only if you understand the concepts along with analysis. That is why my videos take a bit long time. I will assure you that if you can invest the time will not go waste. I will assure you, I will bring in the most crucial topics with a much needed analysis, which is definitely going to sharpen your understanding of economics, which will definitely help you to improve your chances of getting rank in economics as part of your GS3 paper in UPSC mains examination. Once again, I welcome you all. Right. Under macroeconomic performance and policy, in the previous video, as I told you, I covered the topic GDP. In the current video, I will be discussing about the current affairs related to inflation and price indices, which is again a very important topic. Right. I assume that you all know the definition of inflation. Inflation measures the change in the prices of goods and services. Rate of change of prices in the goods and services. Right. If the price is increasing, that's called inflation. There are many other concepts: deflation, stagflation, reflation. So you must all know these concepts, which are very important for both prelims and mains examination. So I will now focus on current affairs. Right? What's happening now? You know something called wholesale price index, WPI. Government is looking forward to change the base year from 2011-12 to 2022-23. Right? What is base year? To measure any indices, right, there should be a base year. We will take the base year as a reference and we will calculate the price changes based on the base year. Even for GDP calculation, we will have a base year. The base year must be periodically revised because the economy, structure of economy is continuously changing, as well as the production nature of an economy is also continuously changing. For example, what was producing in 2011-2012 might not be existing in 2025, or what we are producing currently might not be existing at that time. Right? So it is very important to periodically revise the base year. It is tendency of the government to revise the base year every 8 to 10 years. Right? In 2017, there was a revision of base year. And now government is looking to revise the base year for WPI again. So for that, government has set up a committee under chairmanship of Professor Ramesh Chand, who is also a Niti Aayog member. Right? Under the chairmanship of Ramesh Chand, government has asked the committee to come up with the terms to revise the base year of WPI from 2011-12 to 2022-23. So now you understood why do we have to revise the base year? Right. What is WPI? Once again, these are the basic definitions. Wholesale price index. Right. So to measure the inflation, we have two most crucial indices, that is WPI and CPI. CPI measures the price changes at the consumer level, while WPI measures the price changes at the wholesale level, wholesale prices level. Wholesalers who directly buy from the industries and who distribute the products to distributors as well as retail sellers, and from the retail sellers the products come to consumers. Right? In the chain of supply, wholesalers will come above the retailers. Right? So wholesale price will measure the price at the level of wholesalers. So there we measure the change of price. Through that we will get the WPI. Right? Who publishes the WPI data? Office of Economic Advisor, right, of Department of Promotion of Industry and Internal Trade under Ministry of Commerce and Industries. Very important. So how often they would present? Monthly basis. On a monthly basis, Office of Economic Advisor publishes WPI data. Okay, this is the basics. What all WPI covers? It covers around 697 items, which we don't want to remember. But we have to remember the composition, right? Under WPI, around 22% primary articles, 13.2% we have fuel and energy, 64% includes manufactured products, right? What are primary articles? You know primary sector? What are primary articles? Agricultural produce, food crops, vegetables, fruits, minerals, minor forest produce, everything. All that comes under primary articles. And fuel and power includes your mineral oils, coal, electricity, etc. Right? Followed by manufactured products. Manufactured, the apparels, the automobiles, the machinery, the metals, right? All this comes under manufactured products. So you should know nearly 64% includes manufactured products. The composition of WPI, 64% includes manufactured products, followed by primary articles of 23% nearly, and fuel and power nearly includes 13%. So this infograph would help you to remember primary articles, food articles, non-food articles, including minerals, fuel and power, mineral oils, coal, electricity, etc. 64.2% is your manufactured products, fuel products, chemical products, metal and alloys, textile and apparel, miscellaneous manufacturing, transport equipments, metal and alloys, etc. Got it? So if you observe here, there are no services, only goods. You must remember this. WPI does not include services. Right? This is about WPI. So again, this is a pie chart. You can remember. Right? Pictorial memory is very important. Though you may forget the factual memory, but this pictorial memory will help you to recollect easily. Right? Again, if you want to write, if you are writing any answer related to WPI in your mains examination, it is always advisable to draw relevant diagrams and charts. So these kind of charts will come handy for you. Okay. So while we understand the concept, it is also important to understand the trend, because the questions also depend on trend, recent trends. Okay. So recently the WPI has reached 0.85%. That is the data of April 2025. We also should understand the trend, the graph trend. Right. If you see, WPI has reached negative levels. Can you see? In 2015, it has reached negative levels. And in the last 13 months, since previous 13 months, the value of WPI is getting reduced. Getting reduced. Why? The main reason is falling oil prices and reducing global demand. right? Global economies have become stagnant because of various reasons. One of them is Russia and Ukraine war, right? So due to various crisis hit global economy, they are not growing at a decent pace. That is why the global demand is coming down. That is why wholesale price index is coming down. Got it? Why it touched negative value in 2015? You should analyze this. Why? Go back and check why did it touch the negative value. Mainly because of global commodity slump, especially with respect to fuel, that is mineral oil, right? Suddenly there was a shale gas boom in the USA, right? That increased the flow of mineral oils in the market, but the OPEC countries did not reduce the production. So there was a huge supply and there was less demand. Eventually that led to the fall of prices, right? So that is why WPI touched the negative value in 2015. Suddenly the barrel, per barrel, the oil value was reduced from $100 to $40. There was a huge slump in the commodity prices, especially in the fuel. That was the reason in 2015 the WPI touched negative value. Okay, so recently the value is, now the current value is 0.85. That is for financial year 25. Financial year 25, the value of WPI is 0.85%. So recently, in the recent months of financial year 26, what is the meaning of financial year 26? 20, 25, 26. That has started from April, May, June, July, August. So recently again in July, the value of WPI has touched negative, right? Minus 0.8%. Again because of decline in primarily attributed to lower price of food articles, reduced food inflation and fuels such as petrol, diesel and natural gas. Because of primary articles reducing, see, the thing is, you can ask me, sir, primary articles constitute only 22%, right? Why do you say that reduction in primary articles will lead to huge slump in the WPI? You should understand this. Primary articles acts as raw materials for manufactured goods. If the primary articles price decreases, of course the inflation, that is the composition of 22% composition of WPI will go down. Similarly, the raw materials, if the raw materials price goes down, the finished products price also will go down. So that 65% composition, that includes manufactured products, that will also go down. So primary articles decide the nature of WPI, whether it is going to increase or decrease. So this graph denotes the monthly trend of WPI. Who are going to attend the examination 2027 or 26, they should know recent data. In July, it has touched negative value. Because of lack of global demand, the world is still recovering from COVID crisis. Though India might have seen V-shaped recovery, but the world is still, European countries are marred with heavy inflation, lack of job opportunities, right? Russia is always busy. Russia is busy with the war. USA is debt-ridden, huge debt, right? That is why Trump is resorting to protectionist policies, right? So there are many global issues which are leading to reduced global demand, right? That is the reason we have reduction in global manufactured products prices. Okay, so this is about WPI trend. So what is the significance of WPI? So we saw that there is something called CPI also, right? Consumer Price Index. Then what is the significance of WPI? Right? WPI, it is the early indicator of inflation because it will show us the rise of prices at the raw material level itself. Right? Once we understand, for example, let's say if the fuel prices are going high, we can anticipate that consumer price inflation also will go high. Okay? If the fuel prices are coming down, we can anticipate that CPI will also go down. It's an early indicator for consumer price inflation. WPI acts as an early indicator because it captures input costs before they get passed on to the consumers. Okay. It also helps to measure or monitor input cost pressures for industries. Right? Very crucial. Because consumer price inflation measures the price of goods and services at the consumer level. But for the industries, to monitor the input prices, WPI is very crucial. Because they can monitor the fluctuation in the price of primary articles. Right? And also helpful to formulate fiscal policy. Okay, so these are some significances with respect to WPI. One more important news. Government is also planning transition from WPI to PPI, Producer Price Index. Got it? Ramesh Chand committee or working group, just now we mentioned, right, is mandated, right, to provide roadmap for transition from WPI to PPI. So, working group under Ramesh Chand, Professor Ramesh Chand, who is also a member of Niti Aayog, is mandated with two tasks. One is to revise the base year from 2011-12 to 22-23, as well as to draw the roadmap for transition of indices from WPI to PPI. So, what is PPI? Producer Price Index. What is PPI? If you look at WPI does not include services. Yes? Do you agree? Okay. Secondly, WPI, what is the price wholesaler sells the product? Wholesaler selling price also includes VAT or GST, right? Or sales tax, right? Wholesale price includes what? GST, sales tax. Means what? The price that we are measuring includes other indirect taxes as well, right? This does not directly translate to the exact price of the product. So, increase in taxes also lead to increase in WPI, right? That is one aspect of WPI, right? Third aspect is, just now we saw, WPI includes 22% of composition of WPI is primary articles and around 65% is manufactured goods, right? Curious case here is, let's say, primary articles includes, for example, wheat. Let's say wheat, right? If the wheat price is increasing, okay, the same wheat is used to manufacture biscuit. Biscuit price also is going to increase. Don't you think that we are double accounting the same price rise? We are double accounting the same price rise, isn't it? So these are some issues with respect to WPI, right? There was no service sector inclusion. There is also interference of indirect taxes in assessment of WPI prices as well as double accounting, right? So to get rid of these problems, there is government has devised or proposed, right, to revise from WPI to PPI. To draw the roadmap, government has set up a working group under Ramesh Chand, Professor Ramesh Chand, right? So advantage for WPI, as I told you. First of all, what is PPI? Producer Price Index. I'm a producer, right? Whatever the price I am going to get for selling my goods and services, that is called producer price, right? What is the price I am going to get? It is irrespective of taxes. It also may include my profits. Yes, that is there. But there is no interference of taxes here. Producer Price Index. Got it? Measures price at producer, a producer receives for goods and services. That is called PPI. Okay. Advantages, as we just now discussed, it includes service sector. It avoids multiple counting bias. It also excludes indirect taxes. Right? That is why PPI is very crucial. Right? So, this is not going to happen right away. Emission working group is still drawing a roadmap. Government has to plan to execute the roadmap. So, you don't have to assume that soon after, like in the coming year, WPI is going to replace PPI. No, right? The process has been initiated. That's it. Okay. So move towards PPI adoption. And also, one more important thing, PPI is globally aligned standard. OECD countries, all the developed economies, they already transitioned to PPI. Got it? That's also one of the important aspect with respect to PPI. Right. So transition is aimed at precision and compatibility with advanced economies. Okay. So that's one of the reasons. So you should go through what is the difference between WPI and CPI and PPI. Very simple. CPI includes goods and services. WPI excludes services and includes indirect taxes. PPI includes services and excludes indirect taxes. Very fundamental things. Very important. Again, we'll move forward from WPI and CPI. There is one more payment index. There is one more index with respect to prices. That is called Digital Payment Index. What is DPI? Published by RBI, right? Based on semi-annual period, right? On every March and September, RBI is going to publish Digital Payment Index, right? These kind of questions may confuse you. In prelims, they may straight away ask, Niti Aayog publishes it, right? No. Usually, you tend to mark Niti Aayog because you think that what job RBI has to do in publishing indices, but RBI does it. Okay, Digital Payment Index is published by RBI. Okay, so launched in January 2021, not so important. What does it do? It measures the extent of digitization of payments in India. You all know, digital economy has taken highest priority among government policies, especially from the times of COVID or even before the demonetization times. Okay, so we are moving forward, cash-based economy to cashless economy, or informal economy to formal economy, right? For that, major driving factor is digitization, right? So RBI measures with Digital Payments Index to what extent the economy has adopted to the digital economy, right? So for that, they have devised an index called Digital Payment Index. Okay, so they publish it on a semi-annual basis. What is the base period? 2018. So 2018, they will take it as 100. Based on that, they will calculate how much we have grown from the base year, right? There are 5 broad parameters. Again, you don't have to remember all of them, but just we'll go through them. Payment enablers. What enables digital payment? That means infrastructure, right? Availability of internet, smartphones, bank accounts, Aadhaar, etc. That constitutes 25%. Payment infrastructure on the demand side, everyone should have a debit card or a mobile banking applications or fast-track adoption. There are supply side factors, point of sale terminals, ATMs, QR codes, right? Merchant acceptance points. So this index is based on 5 broad parameters. Again, you do not have to remember all of them, but they are needed. I will tell you why. First, primary composition is payment enablers. What enables digital payments? That constitutes 25%. Mainly internet. Without internet, you cannot, make digital payments, right? And smartphones, bank accounts, Aadhaar cards, etc. That constitutes 25%. Infrastructure on the demand side includes debit cards, mobile banking users, or fast-track adoption. It also measures supply side infrastructure, which includes POS terminals, point-on-sale terminals, ATMs, POS machines, right? You have to, if you go to any fair price shops, they will ask you to imprint your thumb and and also, take your Aadhaar card and they'll serve the rations for you. ATMs, availability of ATMs, QR codes, merchant acceptance points. Majority of the composition is payment performance. What is the volume and value of transactions across UPI, IMPS, NEFT, AAPS cards, etc. Right? And consumer centricity, right? That means awareness of consumers, grievance addressal mechanisms. All these are part of your digital payment index. As I told you, you don't have to remember this, but they're crucial to understand what drives our digital economy. These are the factors drives our digital economy. If there is a question in mains, what are the crucial factors that are driving our digital economy, or where all we should improve to transit from a informal economy to formal economy, right? You can quote these factors. That is why I mentioned these things. Otherwise, as part of digital payment index, you don't have to remember all these 5 parameters. Got it? Okay. So what the data says, the recent data is for till the March 2024, digital payment index stood at 418.77. The value of DPI is 418.77. That means what? We have taken 2018 as reference, that is the value 100. That means in 6 years, our digital payment infrastructure, our digital economy has grown 4x times. It's a huge growth, exponential growth. Got it? In the digital economy, UPI transactions dominates. Okay, as you all know, everywhere we carry the QR code, Google Pay, Phone Pay, all these apps, Beam, UPI apps. 65% of the share belongs to UPI transactions. So this is about digital payment index. Got it? Significance you all know. Deepening financial inclusion, progress of Digital India mission, useful policies, useful for policy decisions regarding fintech, banking, payments regulation, right? Supports India's move towards cashless economy. There are many significances also. It also motivates many startups in the fintech sector, right? Again, there is a broader significance. It helps India, to achieve the, dream of Vikasit Bharat by 2047. So all these are significances. So you should know these generic points, to write your mains answers. These generic points are very important. You can use these points to most of the questions. Got it? So it's about digital payment index. After inflation topic, we'll move on to the next topic, which regard to fiscal health and debt. Fiscal health and debt, very important with respect to macroeconomy. What is the meaning of fiscal? The word fiscal means government finances. Government finances. That deals with how government makes money and where government spends money. Right? So fiscal health is very important along with debt. That is government debt. So the current affairs point here is Fiscal Health Index published by Niti Aayog. Fiscal Health Index published by Niti Aayog. What is Fiscal Health Index? It's annual report, very important. Period of the report is important. What it does, it provides state-wise fiscal performance assessment. State-wise fiscal performance assessment. State-wise, right? Why state-wise? Again, very crucial data. This data you can use in many of your answers. States are responsible for approximately 2/3 of public spending. States are responsible for approximately 2/3 of public spending because all the important sectors, for example, primary education, primary health care, agriculture, rural development, all these crucial sectors come under state list, right? That is why states are major factors driving public expenditures. Okay, right? That is why state level fiscal health performance measurement is very important, right? So it is developed by the data using, data developed by CAG. Not so important information, but again, where does Niti Aayog get the data to compose this index? From CAG. Okay, not so important again. So what are the key indicators of fiscal health index? What are the key indicators? Again, you cannot expect a question like what are the key indicators of fiscal health index, but you should know what are the significant things which contribute to the fiscal health. Got it? You may not expect a question regarding fiscal health index in your mains examination, but to improve the fiscal health, what are the important key factors? right? So here we can see them, right? So what are the key indicators Niti Aayog uses to come up with fiscal health index? What are they? Revenue generation and mobilization. How state governments generating the revenue, right? What is the performance of state government with respect to tax collection, and how are they mobilizing it? Got it? Expenditure management. Expenditure, how are they spending it? Are they spending it for freebies, or revenue expenditure dominates the capital expenditure, or the capital expenditure is of higher percentage than revenue expenditure, which is not the case? So they will measure the quality of expenditure, efficiency of spending, focus on capital outlay versus revenue outgo. What percentage of expenditure is going for capital side? That's about your expenditure management. Third parameter is debt management. What is the amount of debt a state government has? What is the interest burden the state government has? Right? Among the debt, what is the short-term debt? What is the long-term debt? What is external debt? Right? They will understand the debt management side of the state government finances. So basically, debt to GSDP ratio, gross state domestic product ratio. Just like we have GDP at central level, we have GSDP at state level, right? So they will measure debt sustainability. Fiscal deficit management, right? There is a standard for fiscal deficit. You all know, right? FRBM Act, Fiscal Responsibility and Budget Management Act, right? FRBM Act sets the standards for both state and central governments for fiscal deficit. What is fiscal deficit? What is fiscal deficit? Difference between expenditure and revenue. If you are spending more than you earn, it's called deficit, right? If you are earning more than you spend, which is not the case, that's called surplus, right? So what amount of deficit you can have? Got it? So if there is more deficit, then where should government bring the money to fulfill the deficit? They have to borrow. If there is more deficit, then more borrowing. That is why it is important to keep the deficit at a low level, at a manageable level. So that is why the standard set by FRBM Act. According to FRBM Act, state governments have to maintain or strive to achieve fiscal deficit levels at 3% of GDP or SGDP. Right? So FRBM mandates state governments have to strive to achieve deficit levels at 3% of GSDP. So if the government is able to manage that or not, again, that's also a key indicator, right, for fiscal health index. Last thing is overall fiscal sustainability. Overall, in a longer term, how the state government finances are going to perform. So all these are key indicators of fiscal health index published by Niti Aayog. Okay. So again, top performers. Again, in prelims you may expect, because nowadays UPSC is digging deeper into the current affairs points. Again, not so much of expectations. So which are the top performing states? This is the graph that I have straight away taken from Niti Aayog PDF document. Top performance are Odisha, Chhattisgarh and Goa. These are top performing states. Okay. So if you can see this graph, it's a heat map. It's called heat map. Okay. So it measures, it is given the scores regarding quality of expenditure, revenue mobilization, fiscal prudence, debt index, as well as debt sustainability. What is debt index? Interest payment divided by revenue. That's called debt index. That measures what is the debt pressure a state government has. Okay. So if you look at this, many states like Karnataka, as well as Andhra Pradesh, and even the state Tamil Nadu, they're all reeling under high debt unsustainability. Can you see? Scores are very low. Andhra Pradesh it is 0.0%. These points are important for you to understand or address the questions regarding macroeconomics policies of state governments. Because there are debates going on. Many state governments are, they are making huge promises of freebies, right? Free money, free ration, and free bus passes, etc. Okay, so again, how much sustainability is? There is a huge discussion. So you can use this data. Fiscal Health Index of Niti Aayog says under the FSI data, the debt sustainability index for major states like Karnataka, Tamil Nadu, Andhra Pradesh is very low. Right? The value is less than 10, which is concerning. Right? Similarly, you can also think about quality of expenditure. For example, state like Kerala. Quality expenditure means what? They're spending more for revenue. More on the revenue side, not on the capital side. Right? You can quote this data. Okay, so these graphs will give you additional information. So again, I told you, you are not going to get a question regarding fiscal index in mains, but you are definitely going to get a question regarding fiscal health of individual states, how individual states are performing. For example, if you want to achieve Vikasit Bharat 2047, of course, the state governments have to manage their finances well, right? They have to focus more on capital expenditure. Are they doing it right? Where will you get the data? From this graph. Okay. So once again, go to this graph, understand yourself, right? Why government are failing to manage their finances well. Okay. It's about fiscal health index. So what is significance? Again, in general, competitive and comparative federalism. Competitive and cooperative federalism. Very important keywords. States have to compete each other to achieve betterment, right? These indices are going to help. Cooperative means state and central governments have to cooperate to achieve desired developmental goals. For that, these indices are going to be helpful. Resource devolution debates, how the resources have to be devolved. For example, for finance commissions, it will help. This data is going to help where they have to allocate more resources and which states they have to allocate more resources, in which areas. Last point, Vikasit Bharat. This is a generic point. You can use this point anywhere. All right. Significance. With respect to significance. That's about fiscal health index. Next, we move on to debt. Right. Public debt, if you see, under the topic public debt, we have internal debt as well as external debt, right? Internal debt means the debt mobilized by the government from internal sources, domestic sources within the territory of India, like banks. Government will provide G securities, right? Through government securities, government mobilize money. That's called internal debt. External debt means government mobilizes money from external sources, foreign sources. So, we discuss the data regarding external debt. As per the recent data, our external debt stands at nearly $700 billion. Okay. Which is again nearly 19.1% of our GDP. These are very important data. Right? It is because how government is spending and where government is mobilizing its money and how India is globally competitive enough to address many global supply shocks as well as arbitrary trade policies from the likes of USA. That is why we have to understand how stable is our economy, right? So these data is very crucial. Our external debt stands at 19% of our GDP. Okay. Most of the external debt is composed of USD. 54% of our debt is composed of US dollars. Nearly 31% of our debt is composed of INR. That tells us how much we are dependent on dollars. This data is very important when we discuss about de-dollarization. Right? Countries, especially BRICS countries, right? They are planning to move away from dollar dependency. But is it so easy? Right? Data says it's not so easy. It takes time. Right? Because our external debt, majority of our debt is depending on US dollars. It is composed of US dollars. Okay. So again, who are the borrowers? Corporate sectors are the largest borrowers, followed by the government. Not so important data. What are the instruments? Commercial loans from the commercial bodies, right? Banks, etc. Commercial loans does not include the loan that is taken from World Bank or IMF. And FPI in debt. FPI means foreign portfolio investment. In the debt securities. Right? For example, FPIs come and invest in debt securities of companies. Debt securities of government also. Government releases GSEC, right? GSEC. Right? Dated securities, all those are debt securities. If FPIs come and invest in those securities called debt. That's also part of our external debt. Resilience indicator, how resilient it is, how strong, how qualitative it is. It says our debt is 91% of our forex, that is foreign exchange reserves. That means right away, even now, right now, if all the creditors come and ask us, give back all our money, we're not going to trust you anymore. Is Government of India able to pay them? Yes. It's a common sense. If you want to lend money to someone, first thing you will do is, he will understand whether he's going to or is able to pay back the money or not. How do you do it? By knowing his account balance or by understanding his property values, etc. So that is how even international lending also happens. Right? Depending on our forex reserves, we can understand how resilient our external debt is. Okay. Our forex reserve stands at $800 billion. Our external debt stands at nearly $736 billion. That means what? It is 91% of our forex reserves. So we can confidently say our external debt is resilient enough to absorb any shocks. Got it? Again, sustainability of external debt is going on because, see, whenever the political discussions come up, the opposition parties blame that this government has made lot of loan. It is going to transfer the burden of paying the loan in coming generations. So the discussion of sustainability of external debt comes into picture again and again. It also explains our macroeconomic stability. So to understand sustainability of external debt, what are the things do we consider? We just saw forex reserves, right? We also saw what percent of forex is, what percent of debt is of GDP. There are other indicators also. Can look at this graph. Understanding the data facts with the graph is very, very important. Look at this graph. This graph includes current account deficit, that is a bar graph. This blue line indicates GDP growth and the red line indicates debt. If you see, from 2021 onwards, our external debt is continuously rising. It is continuously rising. Now it stands at nearly $730 billion. It is continuously rising. Because we need money to invest for infrastructure development, right? To set up more and more industries, right? So that is why our external debt is growing, continuously growing. So is it sustainable? You can encounter a question, right? The trend of our external debt is continuously growing in the last few years. How sustainable and resilient it is, right? Discuss with respect to macroeconomic indicators. You may face this question in the exam. Though the external debt is increasing, look at the GDP curve. Is it not stable? GDP is stable. Haven't we recovered from COVID crisis? Yes, we have recovered. Then onwards, our GDP is performing in a healthy manner. Isn't our current account deficit is getting narrowed? Now it is 0.5% of our GDP. It is getting narrowed. So these two indicators, doesn't they convey that our debt is sustainable? Yes, they are sustainable. Got it? So previously we talked about forex and what percentage of our debt is with respect to GDP. Those are two macroeconomic indicators. Thirdly, our GDP growth is, it is sustained at a good levels. Our current account deficit is getting narrowed. So all these indicators say that our external debt is sustainable. It can be managed. Okay. There is also one more analysis to understand sustainability. See, only 18.3% of our debt is of short-term nature. Short-term nature. Short-term debts, for short-term debts, government have to pay higher interest. So, nearly 81% of our debt is of long-term. Long-term means long-term debt are made available for infrastructure projects which has higher gestation period. For example, if the government borrows to build a bullet train, it is going to take a long time, right? So government cannot borrow for a short-term period, right? So long-term borrowings are helpful for infrastructure development, right? They are made available for a lesser interest rate. That is why our composition of external debt, nearly 81% includes long-term debts and only 18.3% includes short-term debt. That's also very crucial data to understand sustainability of our external debt. Got it? So, as we discussed, reserves to external debit ratio is 91%. Current account deficit is getting narrowed. So, these are the data indicators that shows our external debt is resilient. Got it? Moving forward, one more current affairs point, very important. Now, government has decided to move towards debt to GDP ratio as new fiscal anchor. Fiscal anchor. Just now I told you in the previous discussion, according to the FRBM Act, governments have to restrict their fiscal deficit to 3%. Okay. That is called fiscal anchor. Anchor means what? Some standard which controls the fiscal policy. Your fiscal policy have to meet some standards. What kind of standard? One standard is fiscal deficit. Right? Whatever the budget you may come up with, whatever the kind of expenditure or kind of revenue sources you may come up with, you should maintain the maximum fiscal deficit level at 3%. That was the standard. That was the fiscal anchor earlier, according to FRBM Act. But recently, government has decided to transit or move from fiscal deficit, fiscal anchor to debt to GDP ratio fiscal anchor. So, from now on, that means from 2026 to 2027, that means upcoming financial year, government has decided to adopt debt to GDP ratio as a fiscal anchor. Right. What should be the target? 50% plus or minus 1% by 2031. That is the target. So, our fiscal policies has to be fine-tuned to reach the target of debt to GDP ratio. That should be the fiscal anchor from the upcoming years. Right? We are moving away from fiscal deficit, fiscal anchor. Understanding? Are you getting it? Yes. Why? Why are we moving from fiscal debt to GDP ratio? You should understand this. Dear friends, debt means government takes loan today, this year, makes some X% of loan. Next year also it makes Y% of loan. Next year it makes Z% of loan. Okay. The debt is going to get continuously added, right? Cumulative. It is going to get continuously added. Got it? Right? That means debt will give you exact idea of fiscal health of a long-term fiscal health. Debt is going to give you long-term or cumulative fiscal health compared to the fiscal deficit. For example, let's say in the current year, production levels are very good. Tax revenue collection is very good. Government doesn't have to spend much or borrow much. Suddenly, fiscal deficit is narrowed for this year, financial year 26. Next year, God forbid, it will not happen. But if there is any crisis, temporarily, the production system is going to go down temporarily. That forces the government to borrow more money. That means increase fiscal deficit. Government have to spend also. If there is no private investment, government has to spend, right? That will increase its fiscal deficit temporarily. Suddenly next year, again, if the production picks up, fiscal deficit goes down. The fiscal deficit is year-on-year measurement of fiscal health. If the fiscal deficit is narrow this year, doesn't necessarily mean that next year it's going to continue the same way, right? Or if the fiscal deficit is high this year, it is not. No, you cannot guarantee that next year it's also going to continue the same way, right? So, fiscal health indicator, that is fiscal deficit, represents only year-on-year changes, but not cumulative changes. But debt to GDP ratio is going to give you cumulative idea of fiscal health. It will help us to come up with long-term fiscal policies. That is why government is moving from fiscal deficit as a fiscal anchor towards debt to GDP ratio as a fiscal anchor. That's not going to happen in this year itself, but in the year 26-27. That is upcoming financial year. Understood? Right. If you have not understood, comment below. Let me know what concepts are not clear. And I forgot to tell you, all these PDFs are made available in the Telegram channel. The link is given below in the description. Kindly follow it and take the help of the PDF that I'm going to explain in the video currently. So, back to the data. Target of debt to GDP ratio is 50 to 51%. Right. Rationale. It allows flexibility for strategic public investment. For example, as I told you, during the COVID crisis, fiscal deficit was high. It went nearly 5%. That does not mean that government is not fiscally well, but to manage the crisis, that violates the limit of FRBM. Right? It's not right to say that fiscal health is, corrupted, or fiscal India is not fiscally healthy, because just for that particular year, government had to spend more. That's it. So by moving to debt to GDP ratio, government will get more flexibility for strategic public investment. If the need be, government will spend more. If there is no need, government will spend less. Strategic public investment. Debt to GDP ratio will give the room. Okay. Recognizes the rigid 3% FRBM deficit limit is impractical. FRBM Act does not recognize the flexibility. It does not give flexibility. Crisis times, what should be the limit? Non-crisis, what should be the limit? Right? FRBM was not so flexible. It is rigid. It was straight away given the target of 3%. Again, we couldn't attain it. But yes, that was rigid. That's the reason for moving towards debt to GDP ratio. One more important thing, global examples, USA, Japan, etc. Right? They also have transitioned their fiscal anchor to debt to GDP ratio. To align with the global standards, India is also moving towards debt to GDP ratio as fiscal anchor. Got it? So I told you why this shift, global norms, etc. What is India's current position? India's current position. What is that? Center's debt to GDP ratio is 58%. States' debt to GDP ratio is nearly 30-32%. Combined, it is nearly 88 to 90%. But what is the target? 51%. What is the year? 2031. So, India has to consolidate its fiscal policy gradually to attain the target from 90% to 51%. India, the government has to do humongous task or reforms to attain the level that is set as fiscal anchor. That's about debt to GDP ratio. Got it? So, as I told you the trend, right? Once you understand data, you should also understand the trend. Our fiscal deficit, as I told you, during the times of COVID, it reached nearly 9%. It reached nearly 9%. But it has come down. Right. Debt also, works in a similar manner. But only difference is debt is cumulative. But fiscal deficit is year-on-year measurement. So that is why debt is a better, anchor for fiscal health. Okay. One more current affairs. Recent RBI study regarding quality of public expenditure. How governments are spending their money. How qualitative it is. Recently, in the previous slide, we saw Fiscal Health Index published by Niti Aayog. You can correlate that FHI with public expenditure study done by RBI. These are very, very important to answer your questions regarding macroeconomic policy of state governments, cooperative federalism, right? Competitive federalism. These points comes handy to you. That is why economics need to be studied, including current affairs as well as including analysis. Facts and analysis have to go hand in hand, right? Then only you can write a qualitative answer. Then only you can confidently approach economics questions both in prelims as well as mains examinations. Okay. So RBI study with respect to quality of public expenditure. What does it say? Key findings. It says rising capital expenditure, right? Recently, since 2000, governments are spending more for capital reasons. That's a good trend. India's average GDP growth is 6.5%, has been closely correlated with higher capital spending. RBI study says, since 2000, India's attained a steady and strong GDP growth. One of the main reasons is the governments are focusing more on capital expenditure. Okay, so currently it is record 3.4% of our GDP, highest in decades. So governments are allocating more towards capital reasons or capital purposes. It is investments in roads, railways, digital infrastructure, energy, social infrastructure, etc. That's the one finding. Second finding is, but revenue spending still dominates. Higher revenue means salaries, freebies, subsidies. Got it. So these are revenue expenditures. Though the capital expenditure is picking up, but the revenue expenditure still dominates. Salary, pension, subsidy, interest payments, etc. Right. Though the revenue to capital ratios improved, India still spends more on consumption than on investment. Why? What does that happen? I mean, why is it a concern? It limits fiscal space. Look at these keywords. Include these keywords in your answers. Automatically, your answers looks more enriched, more professional, more qualitative. Fiscal space. Government needs to have some space to spend on more needs, right? Government cannot just be spending on only salaries, pensions. We have to grow, right? To bring in AI. We have to spend on AI, right? We have to spend on more smart technologies. We have to spend on more smart communication media, smart transportation sector. You have to improve our education system, right? If the government resource only dedicated only for fulfilling basic needs, how can we grow? So government needs to have some fiscal space. But spending only on the revenue side, it reduces the fiscal space for the government spending. Okay. These keywords come handy for you guys. Improvement in social indicators. Third indicator is governments are spending more on social sector. That is why there is improvement in social indicators. Capital expenditure in health, education, rural roads, electrification has led to rising literacy, better health infrastructure, wider electricity access. It shows targeted public expenditure can deliver tangible development outcomes. Look at these keywords. I made it bold because you have to absorb those keywords. These keywords make your answer qualitative, right? That's why this video is taking more time, because I just don't want to convey the data and facts. I want you to be more proficient in economics. Absorb these keywords. Targeted public expenditure can deliver tangible development outcomes. Tangible means measurable, can be seen, can be experienced. Okay. Fourth finding is persistent fiscal stress. Governments are finding it very difficult to match the fiscal deficit target set by FRBM. Fiscal stress. There are more stress, especially during the crisis times. Not only the pandemic crisis, but also the war crisis. Okay. Revenue deficit still remains high, more than 3% of GDP. It's a concern. Interest payments consume 20% of our union government expenditure. Interest payments. 20% of our earnings straight away is going to pay the loan. It is just like you're paying EMIs, right? You take the money or a salary, next day 20% of your salary is directly going to the loan account. As soon as you receive the money, you have no money. You have less room to spend for your betterment. That is one thing that has been observed. Many states run revenue deficit just to finance routine administration. States, just now we saw the state government of Kerala. That is why all this data are interrelated. Quality of expenditure with respect to Kerala state was very low. 6. The index of quality expenditure for the state government of Kerala is only 6. Right? So you can correlate. Many state governments are running revenue deficit only to fulfill their routine administration, salaries, pension, etc. That is concerning. One of the other key points is rising freebie. Every state government or every political party, whenever election comes, they always come up with some promises. Freebies, right? Emotional attraction. right? Winning over the voters by promising something for free. Indians, have a tendency to falling for this freebies very soon, very, quickly, without even thinking about what is going to the, upcoming impact, right? Emotional people. Okay, so rising freebies and inefficiency. Populist subsidies. Many subsidies are non-merit and don't improve long-term welfare. Non-merit subsidies. Non-merit subsidies. For example, giving free money. You never know how are they spending the money. Non-merit subsidies. Okay. Highlights need for subsidy rationalization and direct benefit transfers. Right? You should not allow the money getting leaked in the process of transformation of subsidies, right? So DBT is one measure, and we have to rationalize subsidies also, right? These are the keywords: non-merit subsidies. Those subsidies which are not going to directly contribute for the welfare of people. Non-merit subsidies. So government have to focus on rationalizing subsidies, right? So this is one concern. Last thing is interstate variations. Odisha, Chhattisgarh, Goa, just now we saw in the Fiscal Health Index of Niti Aayog, they are performing better, right? Compared to Punjab, Kerala and Bihar. We just saw the graph, heat map. Got it? Some states are performing better, some states are not performing well. It shows competitive fiscal federalism and better monitoring. Got it? So, all this data are studies done by RBI which help us to help for the governments to improve their fiscal competitiveness or competitive fiscal federalism. Way forward, raise capital expenditure to 3% of GDP with respect to state governments, rationalize subsidies, strengthen state finances, real-time monitoring of expenditure, flexible deficit bands during crisis. That is why we're moving to debt to GDP as a fiscal anchor. Okay. Global perspective. There is a report done by UNCTAD, right? United Nations Conference on Trade and Development. UNCTAD. Okay. Under UNCTAD, what is UNCTAD? It's a permanent commission or a permanent body under UNO, right? It reports to the UN General Assembly. Got it? Its headquarters is located in Geneva. That's external information. Come back to the current affairs. UNCTAD published a report called World of Debt Report 2024. There is a huge talk going on. US is debt ridden, Japan is debt ridden. Many governments or many developing economies are also reeling under debt stress. So for that, this report is going to be handy. Again, for prelims purpose, yes, which body publishes this World of Debt Report 2024? It is of UNCTAD. You hear very less about UNCTAD. So these questions are favorite for UPSC prelims. You tend to read only about World Economic Forum, World Bank, IMF, these reports. But what about UNCTAD? Okay. So what the report says, there is total $97 trillion of debt in the world. Okay. Nearly $30+ trillion debt is made by developing countries. Got it? Debt is growing 2x faster in developing versus developed nations. The key takeaway from this data is developing nations are becoming more and more debt-ridden compared to developed nations. Equitable distribution of resources, creating equal opportunities in the global economy is very, very important. Right? Global economies, especially major economies like USA, are becoming more and more protectionist. Right? For developing economies, it is going to become very difficult to compete with the developed economies. For that purpose, they are attracting or they are falling under more and more debt pressure. How the developing economies mobilize resources to develop industries so that they can compete with developed economies, it is going to become very difficult. This kind of data is going to come handy for you in support of such argument. That is why we need bodies like WTO to be active, to manage world economics, world trade, to make it more equitable and fair. Otherwise, the world is going to become more and more unequal. Yes, my dear friends, right? Due to the technological inventions, disruptions, especially AI, virtual reality, augmented reality, only developed economies are gaining the advantage compared to developing economies. Developing economies are facing it or feeling more difficult to coping up with growing economics of global economy, especially competing with developed economies. So they have no money. That is why they are coming under huge debt stress. That's the data. Debt in developing economies is growing 2 times faster than developed economies. Okay. Nearly $900 billion money is paid as interest by developing economies. That means that much money they cannot utilize for capital purposes. That's a concern. 3.3 billion people live in the country spending more on interest than on health and education. Can you see this data? Very important data. Right? Even they cannot spend for their basic needs, but they're paying more interest. Right? Can you expect them to utilize the technological advancements the world is seeing? Can you expect them? No. They are still struggling to meet their basic needs. How many? 3.3 billion people. The world, what is the global population? Nearly 7.5 billion population. Nearly 40% of the population. They're struggling to meet their basic needs, rather they're paying interest. These are data facts which help you to understand global economy, right? We have to have a responsible economy with equitable wealth distribution, fair and equitable global trade. For all these reasons, we need to have a responsible global multilateral bodies. Is it going to happen? We have to wait and see. What is India's position with respect to debt? We discussed it already, right? Total debt is nearly 90%, which includes state debt of 30%, central debt of 58%. External debt is only 19% of our GDP. Reserve to debt ratio 91%. What concerning is this? 20% of our union expenditure is going to pay the interest rates. Revenue deficit is nearly 3%. This is about India's position with respect to debt. Implications: if the developing economies are paying more and more interest, or if the developing economies' debt is growing 2x faster, what are the implications? Debt servicing is eating up fiscal space. Debt versus development dilemma. Either they have to take care of debt or take care of development. Unless they develop, they cannot come out of the debt pressure, right? Unless they pay the debt money, they cannot develop, right? Dilemma. Where they have to spend the money, right? Very difficult. But in India's case, we have a stronger buffer. We can manage the debt stress. Policy lesson, we have to move towards quality of expenditure. We have to move towards sustainable debt management. That is why we talk about debt to GDP ratio as our fiscal anchor. All these topics are interconnected. Don't take them as individual content, right? To write a better or qualitative mains answer, you need to consolidate these points, right? And last topic for the video is monetary policy. Very, very important topic, very crucial topic. Monetary policy. In India's economic policies, we have two important policies. One is fiscal policy. Other is monetary policy. Fiscal policy is taken care by the government. Monetary policy is taken care by RBI. Until 2016, RBI was alone responsible for that. But in 2016, RBI Act was amended to set up a monetary policy committee, which includes both government and RBI representatives. You all know what is the structure and composition of monetary policy committee. These are very basics. 3 people are from government, 3 people are from RBI. The monetary policy committee is headed by RBI governor. So who is the governor? Go and find out. December 2024, there is a new governor has been appointed for RBI. Comment below what is his name. Okay. Coming back, recent monetary policy decisions. Repo rate 5.5%. Right. One more thing, this Monetary Policy Committee is mandated to meet at least 4 times a year. At least 4 times a year as per the Act. But Monetary Policy is meeting 6 times a year, 2 months once. So now tell me, Monetary Policy Committee is a statutory body or not? It's a statutory body. Okay. So coming back to the data facts. So the recent decisions that are taken in the month of June, repo rate, these are the monetary policy tools, right? You should know what are the tools available with RBI to regulate the monetary environment of economy. One primary ingredient or primary factor is repo rate. It is set to the 5.5%. There is something called marginal standing facility. It will be always higher than repo rate by 0.25%. That is now 5.75%. Standing deposit facility, that is the rate of 5.25%. That is always less than repo rate by 25 basis points. That is 0.25%. Reverse repo rate 3.35%. That will always be less than repo rate. You should all know what is this. What are these terms? You should know the definitions of this. Cash reserve ratio, that is 4%. Statutory liquidity ratio, that is 18%. I will brief about definitions of all these terms. Repo rate is the part of liquidity adjustment facility. Under this rate, commercial banks, scheduled commercial banks can borrow money from the RBI. Got it? They have to pay this much of interest rate. They have to submit the collateral or securities. What kind of collateral? Government bonds, gold, and some percent of cash. Right? So they have to put securities. Liquidity adjustment facility, under which scheduled commercial banks can borrow from RBI. Right? Overnight borrowing. If they find any mismatch of the revenue of the money, which is for immediate need, they can borrow from the RBI at this interest rate. They have to put collateral, that is government securities. Government securities, they have to keep them as collateral with RBI, and they can borrow this much of money from this much at this interest rate. That's about repo rate. Reverse repo rate is reverse. Right? RBI will pay interest for scheduled commercial banks for the money they have kept with RBI. Reverse repo is the interest rate paid by the RBI. Repo is the interest rate paid by the banks to the RBI. And what are this marginal standing facility? Can you see this? It is higher than repo rate. Marginal standing facility, MSF, is also interest rate paid by the scheduled commercial banks to the RBI for the money that they borrow from RBI. But what is the difference between repo rate and repo rate and marginal standing facility? See, for MSF, again it's borrowing from scheduled commercial banks. Do they have to keep any collateral? Yes, they have to keep the collateral. How much they can borrow? They can borrow only 2% of net time and demand liabilities. Only that much money they can borrow from RBI. One more very important thing. Sir, then they can borrow from the repo rate interest rate only. Why they have to pay more interest rate under MSF? Because it's a penalty interest rate. Why? Because now what banks does, initially they go for repo rate borrowing only. They submit all their collateral, all their government bonds as collateral, they get money from RBI. Okay. Now they ran out of all their bonds. They ran out of all their government securities. They don't have any collateral. What they're supposed to do? They still need money. They will go for MSF. Sir, for MSF also they have to submit the collateral. You said government bonds they have to keep. Yes, they have to keep. But from where? From where? There is something called SLR, right? Statutory liquidity ratio. As the mandatory SLR requirement, they have to keep some percentage of SLR in terms of government bonds. Right? Under MSF facility, they can take away some percentage of these government bonds. They can keep them as collateral with RBI and they can take the money. Since they are compromising with their SLR requirements, they will be charged a penalty interest rate. Are you getting it? That is why MSF is higher than repo rate. It's a penalty interest rate, 0.25%. I hope it's clear. Next is standing deposit facility. Right? This is less than repo rate. If the banks have extra cash, right? For example, during the demonetization time, people started to deposit their cash. There was huge cash flow into the banks. Now RBI collected those cash. If the banks have extra cash, they can keep the RBI. RBI pays them some interest rate. That's about your standing deposit facility. It was one-time facility. It was allowed for scheduled commercial banks. Okay. Reverse repo, you all know. Cash reserve ratio. Again, scheduled commercial banks have to keep 4% of their net time and demand liabilities NDTL with RBI. They have to keep some percent of cash. What percent? 4% of cash with the RBI, for which RBI does not pay any interest rate. That's called cash reserve ratio. Statutory liquidity ratio. Again, government have to keep 18% of their NDTL with RBI in form of government securities, in form of gold, in the form of cash. That is 18%. So these are the quantitative tools available with RBI. Quantitative tools available with RBI to monitor monetary policy. Okay. I hope it's clear. So there are two kind of tools, quantitative as well as qualitative. I explained quantitative tools. There is one more thing called open market operations. Know more about it. There is a qualitative tools also. RBI also tries to monitor the balance sheet of the banks. They set standards for the balance sheet of the banks. Asset quality reviews, right? These are the qualitative tools to monitor the monetary health of the economy. If you look at the trend of monetary policy, see, from June 2023 to February 2025, repo rate had kept unchanged. This is called neutral policy stance. Neutral policy stance. These keywords are very important. You will get to see them in your current affairs. If the policy rates have been kept unchanged, it's called neutral policy stance. If the policy stance have been reduced, can you see? From Feb 2025 onwards, our repo rate has been reduced by 0.25%. If the bank or RBI reduces the monetary policy rate or repo rate or policy rate, that means it is ready to lend the banks at a lesser interest rate. That means it is confident of economy. It is confident of economy that if there is more money provided, people borrow the money from the banks, they will invest in productive means. If the bank reduces the repo rate, that means bank is confident that it is not going to create further inflation, but it is going to be invested in GDP or production. So I forgot to tell you, the goal of Monetary Policy Committee is dual goal. One is control inflation and promote growth, right? Control inflation to 4 to 6% and promote the growth, supplement the fiscal policy of the governments. Okay. So coming back to this, if the policy rate has been reduced, it's called accommodative policy stance. Okay, so from 2025 onwards, RBI is continuously reducing the repo rate. Can you see this? Right? From June to August, it has maintained neutral stance. It is recent monetary policy competitions. It has maintained neutral stance. What it shows is RBI is confident about economic recovery. RBI is confident about managed inflation levels. That is why RBI is reducing the repo rate. Got it? One is neutral policy stance, one is accommodative policy stance. What if RBI increases the repo rate? What kind of policy it is? It is called tightened policy stance. If the repo rate is increasing, it's called tightened policy. Reducing, it's called accommodative policy. If it is not changed, it is called neutral policy stance. You hear these terms in your current affairs. That's about monetary policy. And last topic, RBI surplus. Right? RBI surplus transfer. Got it? So RBI is owned by Government of India. Right? Whatever the revenue earned by the RBI has to be transferred to the government. Right? So it acts as additional revenue apart from the tax revenue, it acts as additional revenue for the central government. That's the advantage for central government. So recent data says RBI has transferred a record amount of surplus to the central government. It is highest amount, 2.69 lakh crore rupees. Highest. Now you can ask me, sir, how RBI earns the money? How RBI earns the money? Right? How RBI earns the money? Right? Primarily, foreign exchange gains. Forex gains. For example, today they have bought the dollars for, let's say, 60 rupees per dollar. Now the dollar price has increased to 85 rupees. They will sell it. The profit is gain. Forex gains. Interest income on foreign securities and assets. Foreign securities and assets. RBI invests in the foreign securities. For example, USA, Federal Bank, government securities. RBI invests in the foreign securities, right? So these government securities, again, they are bonds. They also pay interest to RBI. So this is the primary source of income for RBI. It also charges the central government for printing currencies. That's also one of the revenues. But major revenues are these. Okay. So data says currently the RBI has transferred record amount of surplus to the central government. 27% higher than the surplus transferred in previous year. From 2.11 to 2.6 in this, 27% higher. Got it? Very important data. Okay. So how RBI makes money? Again, it's a prelims question. Very important. Okay. And one more thing in the video. Last topic. Household Consumption Expansion Survey. Household Consumption Expenditure Survey. Okay. 2024. Who does it? NSO. National Statistical Office. Under Ministry of Statistics and Program Implementation. Okay. What does it do? It composes household expenditure for consumption reasons. There are two reasons people can spend the money for consumption. One is investment. How much money they are spending for consumption purposes is done through Household Consumption Expenditure Survey. Okay. Right. So why it is needed? How much money people are spending? It tells us that how much they are earning. It also tells us that what is the kind of demand in the market. It also tells us that is it going to create any pull inflation or demand side inflation. So for all these discussions, this Household Consumption Expenditure Survey is very important. What are the major findings? Rural spending is lesser than urban spending. Okay. There is an urban-rural gap. Urban MPC is 70% higher than rural. Right? So urban people are spending lesser than rural people. That means what? There is a huge urban and rural inequality. That means rural income are very much lesser than urban income. Urban-rural disparities. Okay. But the gap is getting narrowed. In 2011-12 it is 84%, but in recent days it is 70%. So we can say that our rural economy is slowly getting into the race because of many initiatives like digital economy, etc. Okay. Consumption inequality. Just what I told you. There is inequality. Gini coefficient measures the inequality. Right. Consumption inequality. Right. If the value is closer to 0, it is perfectly equal. Or if the value is closer to the value 1, it is highly unequal society. So there is reduced inequality. Again, not so important data. Inequality of expenditure is coming down. And where are they spending on? Very important data. 47% of spending is going towards food. For rural. And for urban, 40% is going towards food. That is why all these free ration subsidies are very important initiatives. If the majority of spending is towards basic fulfillment, how the human capital is going to improve? It's a major question. Okay, that is why this data can be of help for you. Again, economics topics are not only important for GS3 paper, but also important for your essay topics. So these data can come handy. Major consumption expenditure is going towards only food. So food is the basic necessity. Still the majority of expenditure going towards fulfilling the basic necessity. That's a concern for us. State variations, again, not so important. That's about household consumption expenditure. So trend over time, both rural and urban, MPC is grown. That means consumption is growing. Consumption expenditure is growing at, forget about rural and urban, you can take this data. Consumption expenditure is growing at 8 to 9%. That's a good trend because India is a consumer-based economy, right? Why Apple and Samsung are coming in and investing in India and manufacturing millions of mobile phones? Because India has more buyers. So this is a good data that Indian consumption expenditure is rising. And this graph you can take it as handy. Virtuous cycle of economic growth. These graphs come handy for your mains examination. What is the meaning? Take this. More consumption. Just now we saw household consumption expenditure survey indicates there is increasing consumption, right? If there is increasing consumption means more demand. More demand leads to investor confidence, right? More companies are ready to come and invest in India. Just like Elon Musk is coming to India. Tim Cook has come to India. More investment means higher employment. Higher employment means higher incomes, right? Higher income means again more consumption. This is a virtuous cycle. This will go on and on and on, right? This is the importance of consumption expenditure. So that ends our topics of discussion in the current video. Though the video looks lengthy, you have to focus on each and every concept, not only for conceptual understanding but also for analytical understanding. Following this video, I have also put important terms, definitions, which we have discussed in the current video as terms of glossaries. Followed by the glossary, we have important prelims questions we can derive from these discussions. Make sure you answer them. Followed by that, we have important mains questions also derived from these discussions, which are very important. Okay. So I hope this video will be helpful for you. And if you like this video, kindly share this with your friends. If you're not subscribed, subscribe to the Joyful God YouTube channel. And comment below if you have any demands or requirements, any doubts. I will be very glad to answer them and reply them immediately. Thank you very much and all the best for your preparation.